Look, I get that the numbers are boring for a lot of people, but they're super important. And so here's a quick little breakdown of the typical expenses that you can expect and that you'll need to consider. Starting off with one of the most obvious ones being your mortgage repayments. But not just the repayments themselves, because your mortgage payments will be one of your largest ongoing expenses in your budget, and this can often include both the repayment of loan principal as well as the interest charged by your lender. And there might be times though where you elect to say go on an interest-only loan, particularly if it's like a quick flip or a forced equity deal where you plan to just get in and get out. It's important to be realistic though about your expectations on your loan costs and just to build in a bit of a sensitivity analysis into your numbers, as well as your borrowing costs and interest rate movements that just might occur over the period of time that you own it. If you look at history, interest rates, they typically sit at around 6%, which is a good number to adopt. Then you've also got lender's mortgage insurance, or LMI. So what is LMI? Well, if your down payment or your deposit is less than 20%, you'll typically be required to pay for lender's mortgage insurance, which protects the lender in case of a default on your loan. Now, it's not always the case, but sometimes there might be government schemes or financial lending products that can help you avoid this requirement. But you've got to remember, this is a pretty large upfront cost and it's usually hidden and capitalized into your loan. So just because you don't pay for it physically doesn't actually mean that it's not coming out of somewhere. It's just that it's added to the loan that needs to be paid at the end. And so make sure that you check all of these costs and check your loan documents, check for upfront borrowing fees, because these little small fees, they can add up to a much larger cost in your feasibility. And look, they're not going to be a deal breaker for you, but watch the pennies and the dollars just tend to take care of themselves. And make sure that you're also checking and reading through your loan contracts to find out where all these hidden borrowing fees are sitting. And look, depending on the type of loan, there can also be significant establishment fees that most people just don't even consider, as well as things like discharging fees and other ongoing fees, which just over time, they erode your profitability. So stay on top of all of it. And if you don't have a lot of knowledge in this area, then I really encourage you to speak to your broker and work out a plan and a budget. And look, if you don't have a broker yet, respond to this email, hit me up, and I'll do a quick introduction to the team that I use. They're terrific, and it's who I use to get all of my loans approved. Now, moving on, we've also got to look at rates and taxes. So what type of taxes am I really talking about? Well, for starters, we've got land tax. It's the thief in the night that just sneaks in and steals your money. So you need to watch this stuff closely. And look, land taxes, they vary by state and location and are typically based on the assessed value of your underlying land. It's essential to budget for these sorts of annual expenses to avoid any sort of last-minute surprises, because more than likely, these are just classified as non-recoverable expenses from, say, a residential tenant or a commercial tenant in a lot of cases. Then on top of that, you've got council rates and charges, and these bad boys, they roll through every year as well. So these costs are usually sort of disclosed at the beginning in a vendor's statement or the contract of sale, so you can sort of start to piece it all together and factor it into your budget from day one. So let's talk about insurance for a minute and the different types that you might incur on an investment property, starting off with landlord insurance. This type of policy usually covers things like property damage, liability claims, and the loss of rental income. And it's different from a standard homeowner's insurance, and it's really tailored for rental properties. You may also need insurance for things like flood or earthquake insurance, depending on your property's location. And this is usually additional insurance to protect against natural disasters. And this has become like super expensive in the last few years. So be really mindful of whether the property is located in like a flood-prone area or not, because it can really start to add up. You'll also need to have like your typical insurances like public liability protection and building insurance policies as well. Then we've got maintenance and repairs, and it's really broken up into two sections. First, you have your routine maintenance. And look, the truth is, no one will care for your property more than you do. So it'll come down to a decision that you need to make around, well, what things do you include in the maintenance? And which things are, say, the responsibility of the tenant? But consider different types of upkeep, such as gardening, cleaning outdoor areas, cleaning roofs and gutters, servicing the HVAC systems, and even regular painting. Because at the end of the day, keeping your property in good condition really helps retain the tenants, but more importantly, it helps maintain your property's value. And then secondly, you've got repairs. And it's easier to budget for ongoing maintenance than, say, a repair, but you should still have a small little contingency to cover off the odd repair here or there, because a repair is really the silent killer in an annual budget. Don't forget to cover off on unexpected repairs that can arise just at any time. So set aside a reserve fund to cover those sorts of costs, like fixing plumbing issues or replacing appliances or addressing structural problems. And then if you don't use the reserve in any particular year, well, then it ends up as a bonus on your profit and loss statement at the end of the year. And remember, if you are having to replace items that are classified as, say, a capital expense, you may actually be able to depreciate these items on your annual tax returns. Next on the hit list is property management fees. And so if you hire a property management company, they'll typically charge a percentage of the monthly rental income, which it sort of usually works out to be somewhere between about 5 to 12%, depending on the type of property. I have normal residential property investments that are charged at 5%, but then I also have more complex houses which are charged at, say, 12%, as the management there is just way more intense. And so it really depends on the property type. Now, the management fee often covers all of their services, which include screening the tenants, collecting the rents and billing, and also maintenance coordination and so on. Now, the second part to management expenses are typically the letting fees. So every now and then when your tenant moves out, you'll need to put the property back on the market, and guess what? Your agent will be hitting you up with another letting fee. So this could be anything from a week's rent all the way up to a certain percentage of the first year's rental income. It really depends on the property manager, so you've got to ask those questions, and it just depends on how the agents want to charge. And so when you're looking to buy a property, it's a really good idea to get this priced in to your quotes and go and see a couple of property managers around the area so that you can plan and budget accordingly. Now, when it comes to utilities, in some cases landlords cover certain utilities like water, gas or electricity. This would usually be covered off by collecting a gross rent. But otherwise, the tenant will pay for utilities and consumption. And for such costs such as water rates and sewer rates and recycled water and so on, this may become a landlord's cost if it's excluded outside of your leasing agreement. And whether these costs can actually be collected from a tenant will be on a case-by-case basis and can depend on your state regulations, which you'll need to go and check. In some instances where there is an owner's corporation or an association, let's say, or a licensing agency involved, you could be up for additional fees here as well. With association fees, you'll really need to ask the question of, will you be required to join any associations as part of owning your property? You may elect to go and join a group or an association to stay up to date with regulations and just certain changes in legislation. As well as you might be required to hold a license for owning your property and managing your property. Like in Victoria, in order to be an owner of a Class 1B or a Class 3 dwelling, you've actually got to be approved as an operator and hold a license with the Business Licensing Authority. And then another question that you'll want to ask is, well, will your property share any common areas with any other property? And if so, there may be a body corporate or an owner's corporation in place which charges annual or quarterly fees and levies. And so this will require you to contribute fees to the maintenance of the common areas and amenities, such as building insurance and common area insurance, management of the common property, and potentially even like a sinking fund or an administration fund. Now, one of the areas that tends to get missed in a budget is the cost of vacancy. And what I'm really talking about here is really the loss of rental income. It's inevitable that if you hold properties for an extended period of time, that you will go through periods of vacancy where no one's renting the property from you. Your tenant moves out and you'll just need to go and find another tenant. I'm always surprised at how many investors just seem to optimistically view their occupancy of a property. You should really be planning for periods of downtime where your property may be vacant, and then having a financial buffer in place can just help you manage mortgage payments and other expenses during these times just a lot better. For instance, when you're doing your sensitivity analysis, I'd count on the property only being occupied for around 48 weeks of the year, and then see if it still stacks up. And another question that you should be asking during your feasibility study is whether you've allocated a budget for legal and accounting fees. This stuff can really add up quickly, and you may need legal assistance from time to time for things like lease agreements or evictions or disputes, those sorts of things and those sorts of nature. Additionally, hiring a specialist property accountant, someone who understands the property market to manage your financial statements and tax returns, might come at a slightly higher cost, but it's really required and can be super beneficial to your overall end of financial year position and tax planning if you're doing it correctly. So don't skimp out on your accountant, because they can and they do have the ability to save you a lot of money. In the early days, I did all of my own bookkeeping to just try and save on costs, and this meant having to have good record keeping habits so that at the end of the financial year I could just hand over the books and all of the documentation, all the MyOb or Xero files to the accountant, and then they can finalize all year-end stuff. Nowadays I've got 2 full-time accountants on the payroll, but you've got to start somewhere, right? And then lastly, we have the marketing and advertising costs of owning a property. These are different to the letting costs that you'll pay to the property manager. And this really relates to whether you're either selling your property or advertising and marketing the property to attract new tenants, which you may need to invest in marketing and advertising to do. This sort of thing includes online listings, signage, and possibly paying for professional photos and staging. And then hopefully you don't have to market your properties too often or for too long, but it's still something that you should definitely be factoring in up front. So there you go, a quick little snapshot of the typical costs to owning and running an investment property. I'll see you on the next video.